One of the ones we don't talk about a lot necessarily, and maybe at an individual level or a smaller company level, is the mandatory repatriation tax.
Hmm.
So when that went through, the U.S. shifted from a worldwide tax system to a hybrid tax system, which is a cross between a territorial system and a worldwide system. So to kind of spell that into English,
Yeah.
right?
Yeah.
In the worldwide system, you are taxed on money you earn around the globe, right? If you're a U.S. taxpayer. However, you weren't taxed on foreign earnings until they were repatriated, right? So maybe we've heard, I mean, the case of Apple, right?
Yeah.
Keeping some piece of IP in Ireland and storing
Yeah.
all its money
Yeah.
there, and right. So that's what they're using right there.
Yeah.
So the mandatory repatriation tax is kind of a transitionary tax, which is supposed to get us from one to our new hybrid system, from our worldwide system to our hybrid system. So basically, it says, hey, come this date, we're going to deem everything as being repatriated, whether it is or not.
Welcome to AFO Wealth Management Forward, a podcast powered by Arrowroot Family Office that's at the intersection of accounting, wealth management, behavioral finance, technology, and entrepreneurship. We help accounting firms and financial advisors grow their practice by going beyond the numbers as we learn from industry leaders and subject matter experts to discover the secret to their success. A podcast that highlights everything from the transformative power of AI to embracing the human-first approach of behavioral finance to help you understand the psychological and emotional relationships to money and meaning. Here is your host, Rory Henry, director at Arrowroot Family Office and author of Holistic Guide to Wealth Management.
Hello, everyone. I have another great guest joining me today. He is a CPA and is accredited in business valuation by the AICPA. He's a senior manager with DeJoy and Company. He's been published in wealthmanagement.com as well as CPA Trendlines. We're here to talk about valuation, succession planning, and trust and estate planning. So without further ado, let me introduce our guest, Anthony Vignette. Anthony, welcome to the show.
Thanks, Rory. So happy to be on here and talk to you and your audience about some important issues that I think are undiscussed by business owners, maybe for fear of morbidity revolving around estate planning.
Yeah.
So we're here to kind of demystify some of these ideas, make them a little more digestible, and give you some ideas how you can move forward.
I love it. I love when people can make things easily digestible. So let's start out and kind of give our audience maybe some foundational aspects of gift and estate planning to start out with.
Yeah, I mean, I think the first question to answer is, I use the term estate tax optimization, right?
Yeah.
I think a lot of times we talk about, exits and all these ideas when we talk about them in pre-tax dollars. That's wonderful, right? Till the tax man shows up and it's a different conversation.
Rubber meets the road. Yeah.
I always talk in post-tax dollars, and that's so important. And I use a concept called the estate tax optimization. So what is that, right? First of all, and why is it important for business owners to think about this? Well, estate tax optimization is the process of strategically and proactively planning for gift and estate tax compliance to efficiently transfer wealth over generations, right? I always say as a CPA and an advisor, my job is to help clients first establish and then preserve their legacy. And a lot of my work comes on that preservation piece.
Yeah.
So business owners specifically are particularly challenged by this due to lack of liquidity, right? So if I'm a business owner, I might have 90% plus my wealth tied up in an illiquid business, right? Not a good place to be, certainly not with an estate tax issue. Additionally, we have succession planning risk, right? So I have a huge management risk in that asset, right? If I die and I have, 100,000 shares of Apple stock, it's okay. The company's still going to run.
Right.
If I die and I'm the CEO and owner of my company, that's a different situation, right?
Yeah.
So I have a different risk profile there. So we need to plan around that. It's really germane today, for a few reasons, right? We have a huge wealth transfer, the great wealth transfer.
Yeah, I think it's 90 trillion now we're up to. It seems like just a couple of years ago it was 70 or 65.
I think
inflation.
I've seen 38 trillion, I've seen 90 trillion. Whenever you're starting with a T, the trillion category, it starts to become an incomprehensible number. But it's a big number, and a big part of that is in privately held businesses, right? Yeah. And then we also have pending, I don't know how to call it, law change, right? It's technically the act formerly known as the Tax Cuts and Job Act. That is not actually written into legislation. That was the last thing got stripped out of it, was a name on it. It's Public Law 11197 or something.
Okay.
If we're going to get technical with it. But we'll talk about that idea and why that's kind of important to plan today in our certain environment. So, but that's kind of why I like to focus on this estate tax optimization standpoint. Really important today.
Yeah. Well, let's dive in here. Maybe we can talk about the next 18 months are a crucial time period because of the sunsetting of that provision. The current exemption right now is 13.61 for an individual. It's 27.2, I think, for a couple. So can you kind of talk about what we're looking at and the need to act now with the sunset of that provision?
Yeah, definitely. So I think the important fact is, how does the gift and estate tax work, right? If I'm
Yeah.
going to plan for it, I better know dang well how it works, right?
Are you an accountant looking to generate more revenue and secure your future success as automation and artificial intelligence revolutionize the accounting profession? If so, contact us at AFO Wealth Management Forward. We specialize in helping accountants and advisors just like you build a custom brand to pinpoint your optimal clientele, generate highly qualified leads through our data-driven digital marketing, and execute wealth management growth services to bring more value to your firm and your client's life. Our strategic approach to branding, marketing, and wealth management is carefully tailored to attract ideal clients, increase customer retention rates, and cultivate lasting relationships with clients across generations. Visit wealthmanagementforward.com to book your free consultation to find out how you can elevate your practice.
So actually, the gift and estate tax are two separate taxes, right? Completely separate in the code. We have one thing that unifies them, and that's called the unified credit, aptly named. Right? We don't ever talk in terms of unified credit. We talk about it when you gross that up by the tax percentage, which turns into that 13.6 or 27.2 with portability for a married couple that we just talked about. And we use the term exemption, or maybe you heard exclusion as well used on that. So we have our lifetime exemption here is what we're talking about, relative to maybe you've heard of an annual exclusion, which isn't very meaningful for ultra high net worth individuals. But how the gift and estate tax work is it's taxed based on the fair market value of our lifetime gifts and estate, less an exemption amount, right? That 13.6 we alluded to, times a tax rate of 40%. So let's talk about those variables we have in there. So the fair market value of our lifetime gifts and estate, highly variable, highly dynamic, changing all the time, right? We know that. I mean, recently, I don't know when this is going to come out, but we might have seen the Dow Jones in your stock portfolio drop significantly in just the last couple of days, right? That's kind of the same concept here that applies to private businesses. Those valuations are constantly changing, right? We have our exemption level. Now that's relatively static. That's adjusted by inflation amount every year by the IRS, except for right now, we're in a unique standpoint where we have a sunset from a prior law enacted in 2017 that's going to expire January 1st of 2026. So in 2017, the exemption amount got doubled, right? So it's going to cut in half starting in 2026. So we're probably looking at overnight going from 14 million to 7 million, 28 million to 14 million. So you might hear, well, at $28 million, I'm not going to have a problem with that. $14 million, I might start having myself or clients who might have an issue with that. Or maybe I'm a CFO of a privately held business and my owner might have an issue with that, right? So how do we start planning for that? And that's barring congressional action. Of course, I don't have a crystal ball, but I don't think the Congress could agree on a pizza order. So I don't think tax law is going to get changed in the next year and a half or so. So right now, that's a unique fact pattern. So I want to kind of put a pin in that and say, let's talk about that more in a minute. And then that tax rate, that's 40%, right? So very significant when we're talking about the fair market value, right? So once you get over that exemption amount, 40 cents of every dollar is going to get taken away by the IRS. That's not even counting state law, right? So if you're in New York State like myself, there's also a tax burden. So some of these strategies we're going to talk about at the federal level also have some benefits on the state level as well.
Yeah. Well, let's talk about that fair market value because there's a difference when they assess value, depending on if it's a gift or obviously within the estate and the death of a taxpayer. Can you go over how they determine the fair market value there?
Yes, exactly. And that's where the conversation really happens, right? When we're talking about that highly dynamic number. So I personally can't do anything about the exemption, right? And although we have that one-time planning factor we can talk about, we have a static tax rate. But the difference is the lifetime gift and estate, that fair market value is highly dynamic. So how can I plan around that, right? So fair market value, right? So that's defined in the code. It's a property at which the price would change hands between a willing buyer and willing seller. 4 words you need to know there. Willing buyer, willing seller, having reasonable knowledge of relevant facts, etc. So value is in constant flux. I mean, that's an important thing to talk about. We have 3 approaches to how you do that, right? So we have our income approach, right? We have our market approach, and we have our asset or cost approach, right? So we have our 3 approaches, and those further stratify down to methods. So maybe we're familiar with the discounted cash flow method, right? The DCF. that is a subsect of the income approach. Market approaches, think of EBITDA multiples, right? A term we throw around a lot. And then the asset approach tends to be less meaningful. Hopefully we get more meaning out of the income or market approach. But the thing to understand there is that valuation is the confluence of cash flow, risk, and time. There's nothing else involved. It's those three factors. Cash flows are cash flow, risks are risks. Time is something we can potentially control. So let's put a pin in that as well. And valuation is a picture at a point in time. Really important to understand there.
Yep.
And that's where we start to take power back when we talk about assessing this tax, is that in gifts and estate, we kind of grouped those in earlier in our conversation, but those are actually two different things. We control the split of what's a gift and what's an estate. So that right there, coupled with the time factor we talked about earlier, creates a planning opportunity.
Yeah. Let's talk about that planning opportunity, because obviously there's the ability to gift an asset and how that can potentially affect the value of that asset depending on when the time of the gift was made, and obviously the death of a taxpayer.
Yeah, definitely. So there's a couple of strategies there. You might see the one of don't do anything at all. I can tell you that one doesn't work out well for most people. So I'd advocate against that as a starting point. But so if you're a business owner, right, that can be a classic operating company, right? You know, mom and pop manufacturing co.
Yeah.
That can be real estate portfolio, right? Theoretically, if I'm holding real estate, I'm hopefully doing that through an LLC or another legal entity, right, to limit my liability. There's a planning opportunity there. That can be through a marketable securities holding company, right? If I have a big enough portfolio, maybe I'm holding that through a separate company structure. And then also maybe something like a family limited partnership that we can talk about more later.
Yeah.
But there's plenty of opportunities for that. So transferring those types of business interests can be more efficient than transferring cash. Generally other assets too, right? Whether that's marketable securities, other pieces, or certainly no transfers at all, as I alluded to earlier. The no planning strategy is not a strategy, in fact.
Yeah.
So what are the reasons for that, right? Why is it more beneficial to target these private business interests, right? We have appreciation, right? We'll get into that in more detail. We have minority discounts. We can talk about those in more detail. Those two are perennial fact patterns, right? Those happen all the time. We can always use those. And then we have this one-time planning opportunity right now. I call it the use it or lose it.
Use it or lose it, yeah.
Right? So on the sunset, the IRS has prescribed, not in specific writing, but they have put it in writing, and I think it was through FAQ or something, that they're going to honor gifts made. So let's talk about a quick example here. You know, I pass away on January 2nd, 2026, very unfortunately. I gift away my whole estate, which was, let's say, $14 million a couple days before that, right? Well, now I passed away in 2026, meaning the exemption is no longer $14 million like it was when I gifted it. So I couldn't make that gift without any gift tax. Now I passed away, and now the exemption is $7 million. So they can say, oh, we're going to claw that back. They have come out and said that they are not going to do that. They're not going to claw that back. So that means we have a use it or lose it, right? You can do it now, or you're going to get it never.
Yeah.
So that's a huge fact pattern right now that's unique, and I hopefully going to drive some good planning opportunity, get people to the table to start having these discussions that aren't necessarily fun and are sometimes hard, but get people to the table and start having some of these conversations.
Yeah.
Yeah.
I always talk about estate planning being the family office level of care when we work with clients, because people don't want to talk about death and money, but it's really a crucial conversation that we need to have, especially people who may fall in the window of opportunity here to do a use it or lose it type of scenario. Let's talk about that minority discount, because there is a discount for lack of marketability. There's a discount for lack of control. Can you talk about those minority discounts here for our audience?
Yeah. So minority discounts, I think, are often not understood or misunderstood, right? So what are they, right? So our primary methodology, right, that we're going to use, when I talked about earlier, that income approach, market approach, asset approach, right, that's going to yield a marketable value and most likely a controlling value as well, right? But if I'm gifting off a minority interest in my business, right, so theoretically I would target minority gifts, right, 1%, 2%, 20%, something 49% or less, then I can take advantage of these minority discounts. So discount for lack of control, right? Meaning I don't control the business, right? So let's say in an example for maybe a real estate holding company, I have a big piece of commercial real estate and I'm going to gift off 1% of that off to one of my heirs in a trust or something. That 1% interest isn't worth the pro rata piece of the whole, right? Because that 1% interest, he doesn't get to vote on decisions we make. He doesn't get to complain about the tenants. He doesn't get to tell us what to do. He doesn't get to make us make distributions, right? He can stomp his feet all he wants, but he lacks control, right? And our starting methodology is going to be at a controlling level. So that typically ranges maybe 8 to 12% discount. So it's substantial, right? Nothing to sneeze at. And we usually base that off, observed market rates. We also have some different studies we can benchmark there. The other one that I call it the big brother, the discount for lack of marketability, that can range anywhere from 25 to 35%. It's significant.
Yeah.
So that's based on, we have empirical data, right? I mean, evidence-based. That's typically the form of restricted stock studies. We have pre-IPO studies. We have a couple different sources there. We also have theoretical studies, right? So if we think about what a discount for lack of marketability is the ability to create liquidity, right? So we think about in a private business, how do I create liquidity? I can just get distributions, or we can do, a big sale, right? We can sell the whole company, or I can sell my individual piece possibly. Now, if I'm a minority interest holder, right, I probably restricted by my operating agreement, my LPA, whatever, from selling it, right? I probably have a no transfer clause in there. I also don't get to demand the company sell, right? I can't sit there and go to the thing and say, hey, I think we should sell this private equity firm. I can say it, but it doesn't mean anyone's going to do anything. And I have to get a majority vote to go with me, or a managing member to back me. So I can't create liquidity that way. I also can't create liquidity by demanding distributions, because that's probably at the verdict of either a managing member or that majority voting control. So as much as I can sit here and stomp my feet and say, I want a big distribution now, that doesn't necessarily mean I'm going to get it, right? So when we think about that, we could say, well, that looks a lot like a put option model, right? So if we talk about a put option, something to protect, hedge against downward value moves, then downward price moves. So we can also use something like put option model, or even a DCF model we could employ. We have a lot of different options there, but DLOM is really important, really crucial for planning. Also the most scrutinized thing I deal with on a day-to-day basis. So if you are going to plan here and you're going to make one of these, really kick the tires on that before you put it in front of the IRS.
Well, let's talk about the IRS now here, Anthony, because I know there was a case, Moore versus United States, and you talk about why it is so important. I know there's obviously a lot of complexities with valuing assets, and you have the government involved here. So let's dive into this case and why you feel it's important here for our audience.
Yeah, I always talk about Moore, and I guess I kind of got drawn into it just because it kind of captures every aspect of the things I deal with in my profession. So I just got really entranced by it early on.
We got to get you to do a documentary on this case.
Right? But so Moore versus United States, it's a court case. It's currently in front of the Supreme Court of the United States right now. Guess what the tax bill disputed on is? $14,729. We got 9 justices working on this, and probably a lot more lawyers. Okay, so why does it matter? Why do I care about this $14,000 tax bill that the Moores are disputing, right? So Moore lays a groundwork, I think, for the future of taxation in America, which is why I think it's so important, right? I mean, it's the most consequential thing we've had, certainly since 2017, but you could probably argue since 1986. I mean, this is the future. So the disputed tax bill is the mandatory repatriation tax, the MRT. So previously we referred to the act formerly known as the Tax Cuts and Jobs Act in 2017. So we know a lot of changes.
Hopefully that can stay alive.
Yeah, we'll see. But from that perspective, right, we know a lot of the changes that came about from that. One of the ones we don't talk about a lot necessarily, and maybe at an individual level or a smaller company level, is the mandatory repatriation tax. So when that went through, the U.S. shifted from a worldwide tax system to a hybrid tax system, which is a cross between a territorial system and a worldwide system. So to kind of spell that into English, right? Yeah. In the worldwide system, you are taxed on money you earn around the globe, right? If you're a U.S. taxpayer. However, you weren't taxed on foreign earnings until they were repatriated, right? So maybe we've heard, the case of Apple, right? Keeping some piece of IP in Ireland and storing all its money there, and right? So that's what they're using right there. So the mandatory repatriation tax is kind of a transitionary tax, which is supposed to get us from one to our new hybrid system, from our worldwide system to our hybrid system. So basically it says, hey, come this date, we're going to deem everything as being repatriated, whether it is or not, right? That we're going to say this is repatriated, here's the tax on it. So what happened from that, and what the Moores are arguing, is that this concept of realization, right? Meaning I actually got cash in hand from it.
Right.
They're saying that is enshrined in the 16th Amendment to the United States Constitution, which is Congress's right to tax. They're saying that realization is a part of that. So we didn't realize any money from this investment, therefore we shouldn't be paying tax on it. There's case laws both ways for and against that, but it's a really important thing to talk about in the context of, well, why? Why is the MRT that important? Why is that consequential to, if I didn't even know we changed tax systems as a taxpayer, why does it matter?
That's important.
So why is it important? So it's that issue of realization right there. It's not that anyone's concerned about this $14,000 bill. It's what goes along with that. So we have the idea of a wealth tax that started floating around and was kind of probably viewed pretty loony and cringe and fringe when Elizabeth Warren talked about that in 2020 on the campaign trail. But now it's become much more mainstream as an idea, right? I mean, every one of Green Books from the Biden's administration through to its most recent one in 2024 included the idea of a wealth tax. They call it the billionaire's tax, which is applied on anyone with $100 million or more, which is a weird definition of a billion. I get it, I'm a millionaire by that definition. But so there's a multiple outcomes that could come out of more. It's not going to settle the whole thing, right? It's going to be a significant factor in laying the groundwork potentially for the legality of a wealth tax in the future. And the reason it come to me as such an important thing to talk about is a lot of the concepts that come with addressing a wealth tax line up directly with estate tax optimization. So to me, it kind of felt very germane to my work. And it was funny. I was looking at this and talking about it and covering it before all the big news organizations picked it up. And then I was like, why is no one talking about this? And then it just came on like a floodgate. Like, I mean, every day there's somebody posting something about it, or, Forbes covering it or whoever. So really important to watch. Don't get caught up in the minutia of it. Just trying to focus on the broad strokes outcomes of it.
Yeah. I mean, we already have somewhat of a mess of a tax code currently. We're understaffed with the IRS. This seems like it would bring a potentially a whole new hornet's nest to our tax code.
Yeah, I mean, the knocks against it certainly are our lack of compliance structure for it, right? So when we talk about the traditional income tax, right? We have a whole compliance structure. We have CPAs like me all around the country built to do this. We don't necessarily have the same infrastructure built for that. So that's definitely a knock against it. In terms of IRS staffing, I mean, they've gotten their big bonus recently, so they have a lot more money to do that, right? So, and they're deploying that. Another thing I think it's important to talk about with planning. So if we talk about when we file a gift tax return, right, I have a 3-year clock. So assuming I meet adequate disclosure, which is the term that's called there, within 3 years of filing my tax return, it's then closed, right? They can't go back, open it up, audit it, do anything to it. If I did adequate disclosure, I'm good. If I didn't, I have a permanent audit risk, but that is what it is. But why does it matter then, that 3-year clock? Well, if I get it running now, when the IRS is still upstaffing, right, and they're spending that $8 billion, they're bringing on a ton more staff, they're getting people more, trained, up to skill, efficient as an IRS agent can be. Assuming there's going to be more scrutiny on things. So another aspect that planning now could be beneficial is just to avoid scrutiny. You could do everything by the books, do everything right, not take any aggressive discounts, anything crazy. The compliance cost of dealing with an IRS audit is still substantial. So you could do everything right, win on every accord, and be out a substantial amount of money just for the compliance cost. So really good benefit of planning right now. We're still seeing scrutiny at that lower level. I think something like 63% of IRS audits are people making $200,000 or less. So the big promise was that we're only going to target these high net, 100% of them were going to be, $400,000 or more earners, right? Which I guess theoretically could say that they're auditing people who have reported no income or something crazy. So maybe that skews the stat, but don't think just because, well, I'm Joe Schmo, why are they auditing me? They're busting up everyone. So just be prepared and do the best you can to deal with that.
Yeah. Well, let's go into, I know we briefly touched on it, the family limited partnerships and the pros and cons of doing that type of entity selection, and what ways can we use gifting to kind of work with the estate and gift tax exemption here, Anthony?
Yeah. So, I mean, we kind of play a unique role as advisors. For me, sometimes I go in and I'm the CPA and I'm just going to give them, sometimes the valuation expert, sometimes the M&A guy, a lot of times I kind of feel like the family therapist at the end of the day.
That's what
Right,
we
where
are.
I'm just managing emotions. I'm dealing with the brothers and sisters, and that. But overall, I just want to be that consigliere, right?
Yeah.
I don't want to micromanage the process. I never tell a client what they need to do. On technical issues that I really have a ground on, I'll give them 3 options and I'll pull out one of them and say, I really think this one's the best, and here's why.
Yeah.
I tend to try and ask leading questions, right? My goal is to get the client to organically come upon that idea that I want them to go with. When it comes to internal succession planning, right, we're talking about, maybe an example of a family, right? We have a, substantial, family wealth. Transitioning that over, and that's not just physically transitioning the equity over, that's transitioning
Business.
the management of it.
Yeah.
I mean, everything that goes into that. That's where I play it very careful, and I try to not give overly prescribed guidance. I kind of let the entrepreneur be the entrepreneur.
Yeah.
I'll give them points. I'll give them tips. I'll lead them, say, hey, are you doing this? Are you doing that? How's so-and-so doing? One strategy that I do like and I will talk about is flips or flicks. So family limited partnerships or family limited LLCs. They're a highly customizable vehicle for generational wealth transfer. They're effective because they provide some continuity of stewardship over the family assets, i.e. succession planning, and they also provide an opportunity for estate planning. So the best part about them isn't that they do those 2 things, it's that they let you take those 2 timelines and split them apart. So I can succession plan on my succession planning timeline, and I can estate plan on my estate planning timeline. So I'm not rushing one without the other. So in a traditional standpoint, the matriarch or patriarch of the family would contribute, the assets of value to the family limited partnership in this case. Then they would gift out the shares of that, limited partner shares of that. They'd retain the GP stake. So they could move a significant amount of wealth, but they're still the GP, right? They're still controlling it. They're still making decisions. The other thing I like about a family limited partnership is it puts a paradigm for organization around it, right? I need to be having my board meetings.
Yeah.
And that's what a lot of people need to do when you become a higher net worth individual, especially if you're dealing with multiple businesses or multiple ideas. We need to think like a business, right? We need to be a family, right? But we need to think like a business. So it puts that structure around things, right? I'm having my board meetings. I'm doing this. I'm doing that. I just put this whole framework around. I'm looking at financial statements, right? How many families out there aren't, but should be looking at financial statements every quarter, right? I just create all that structure organically. And oh, by the way, I create a really efficient estate planning vehicle too.
Yeah.
So I like it because it does both those, right? My point with family partnerships, I always say, you got to be authentic with them. Go in there, do the hard work, do those things, really manage that what I call the continuity of stewardship, right? Manage that. We'll get the other benefits with it.
Yeah, I love it. I love it. Anthony, this has been so informative. I really appreciate you coming to the show. Is there anything that we didn't touch on that you want to share with our audience here?
I think that covers about all I got. I could talk all day if you let me, but in the ideal of time management, let's keep it light. But if you do want to find anything from me, I'm very active on LinkedIn. I publish a monthly newsletter. I do that in email, and I also do it on LinkedIn. Contents, thoughts I'm doing. I just try and get those out there. I'm really focused on demystifying these concepts. I really hate that CPAs feel like some person I meet with once a year that is really weird and I don't like talking to, right? I'm trying to make these concepts more accessible and make us as a profession more accessible to people in general. So happy to come on, happy to talk to your audience and hopefully demystify some of these concepts, not make them scary, make them doable, and let me show you how you can do that.
Yeah, I think you demystified and you made it digestible here, Anthony. I really appreciate you coming on the show. I'm looking forward to having you back on when we get the results of the Moore versus United States case.
Happy to cover it. Yeah. Book a couple hours for that one, will you?
Exactly. Cool. Thank you for coming on, Anthony.
All right. Thank you, Rory.
Ready.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.